Hey, John Mayfield with Global Real Estate School, and thanks for joining me for another video where we're diving into the financing areas. I'm in Memphis, Tennessee, staying at the same hotel I was at 2 weeks ago, believe it or not, for the RIA conference, and actually did a podcast video right over there. Beautiful area. I'll let you kind of take a look there. You can see out the side. So great location, and always enjoy coming to Memphis. A great group of folks I've been teaching at the Memphis Association of Realtors. We want to talk about financing. Yesterday I talked about a mortgage. How many parties? Two. Mortgagor and a mortgagee. Mortgagor is the borrower. Mortgagee is lending, right? Today I said we would kind of dive into a deed of trust. Now, with a deed of trust, we have three parties. We have a trustor, we have a beneficiary, and we also have the trustee. The trustor is the borrower, just like the mortgagor, and the beneficiary would be the bank. They've lent you the money, and so they are the beneficiary. Should something happen, that property is going to come back to them, as provided you have a loan. The loan's not been paid off. The bank will then appoint or assign what is called a trustee. Remember, three parties in a deed of trust. The trustee is normally going to be like an attorney for the bank or the title company, and basically they have two jobs. Number one, take the property back from you. In other words, foreclose should you violate any of the terms of the agreement. That's one of the items. And I say violate any of the terms of the agreement. We want to think in terms of, oh, you didn't make your mortgage payment, and so the bank's going to foreclose. Well, if you don't pay your insurance, the bank could foreclose. If you don't pay your taxes, the bank could foreclose. If you don't follow any of the terms of the agreement, the bank could start foreclosure proceedings. That could be as simple as you allowing someone to assume your loan, or you sell it on a contract for deed. That's why there's a due on sale clause. You can't do that without the bank's permission. So the trustee has two jobs. Number one, get the property back, foreclose should you violate any of the terms of the agreement. The second thing the trustee is going to do is issue what is called a deed of release, or a deed of reconveyance. In other words, when you pay off the loan and you have no more obligation to the bank, then the trustee will see to it that they will issue that deed of release or deed of reconveyance. And what that does, they will record that at the courthouse. It gives notice. Remember, that's called constructive notice, notice to the whole world that that loan's been paid off. When you sign that deed, the deed of trust, they're going to record that at the courthouse to show the whole world, again, constructive notice that you have a loan on the property. So mortgagor, two parties, mortgagor and a mortgagee. Deed of trust, three parties, trustor, borrower, beneficiary, the lender, and then you have the trustee who has those two jobs. Get the property back if you violate any of those terms of the agreement or do not make your payments. And number two, issue that deed of release or deed of reconveyance when you pay off the note. So what's a mortgage and the deed of trust all about? Well, they actually are used to secure the property. Normally, there are two documents that you will sign. Number one is the note, and number two would be the deed of trust or the mortgage. The note shows evidence of the debt. It's the financing instrument. It spells out how much you borrowed, your number of years, the interest rate. It's the financing instrument, shows evidence of the debt. The deed of trust or the mortgage is what actually secures the property. So we're going to keep diving a little deeper into this. It can get complicated, but for the exam, several things you need to remember. Mortgage has two parties, mortgagor, mortgagee, mortgagor, borrower, mortgagee is lending, and we have the deed of trust, trustor, borrower, beneficiary is the lender, they've loaned you the money, and the trustee is that third party that's kind of taking care of those issues if you don't follow the terms of the deed of trust to get the property back for the beneficiary, and let the whole world know that through constructive notice by filing a deed of release or a deed of reconveyance when you pay it off. So, hope this helps you out. We're going to keep digging a little deeper. I want to just take baby steps with you on these issues because they're kind of complicated and they can be a little bit challenging. But through my YouTube channel, you're going to be good to go for the exam. Hey, be sure and subscribe, like this, tell other students in your class to come out, subscribe. Remember, there's a whole playlist with financing videos, so watch those. And I'll be back tomorrow. We're keeping the streak going. I think I'm at 12 days in a row. And I have a method and a plan, but I'm going to try to keep it going. And so even if I have to do short videos, I want to give you something meaningful to help you pass the real estate exam. Don't forget, we have flashcards. We have courses to help you pass the test. We have My Real Estate Exam Coach, works in all 50 states, and so much more. Well, you have a great day, and thanks for watching, and I hope that you will consider a career in real estate. If you're going through real estate school right now, I just hope you have an amazing career. I've got resources at my website to help you grow your business too, so check those out. Thanks again for watching. Hope you go out and have a great day.